This is a presentation for Chapter 13, Stockholders' Equity. In Learning Objective 13.7, we're going to use earnings per share, rate of return on common stockholders' equity, and the price-earnings ratio to evaluate business performance. So investors are constantly comparing companies' profits to determine where best to invest their money. So when you have companies that are of different sizes, then we need to have some type of ratio so that we can compare these different size companies to each other. So we're going to look at three of the most important ratios that are used to uh, compare profitability among corporations. And these are earnings per share, rate of return on common stockholders' equity, and the price earnings ratio. So we talked about earnings per share already in the previous presentation, and we saw that earnings per share is required to be reported on the face of the income statement. So that gives you some idea of how important this ratio is. And earnings per share, as we saw, is the amount of a company's net income, or it could be a loss, for each share of its outstanding stock. And we're going to look at earnings per share, specifically calculating it for Kohl's. So on this slide, we have information from Kohl's Corporation's fiscal 2018 annual report. So we have their net income for the years that ended February 2nd, 2019, February 3rd, 2018. They show they had no preferred dividends. We have their total stockholders' equity. We had no equity attributable to preferred stock. And then we have the number of common shares outstanding for both of the years. And these amounts are, of course, in millions. So how would we calculate Kohl's earnings per share for fiscal year 2018? Well, we would take their net income, which was $801 million. We had no preferred dividends, so we would not need to subtract anything in the numerator, but we would divide the $801 million by the average of 163 million and 168 million shares. So we would take those two amounts and divide it by 2. When we do that, when we make that calculation, the earnings per share for Kohl's would be $4.84 per share. Now, the earnings per share is very important, partially because it is used to calculate what is called the price earnings ratio. So the price earnings ratio is a ratio of the market price of each share of common stock divided by the company's earnings per share. So what it tells you is the value that the market places on $1 of a company's earnings. So how do we calculate it? We take the market price per share for the common stock and divide it by the earnings per share. So on this slide, we have the price earnings ratio for Kohl's Corporation. So in this year, for fiscal year 2018, the market price for Kohl's was $65 per share. When we divide that by the earnings per share of $4.84, we get a price earnings ratio, or PE ratio as it's called, of 13.43. So this ratio, again, is commonly used by investors to evaluate their ability to earn a return on their investment. So it tells the investors how much they should be willing to pay for $1 of a company's earnings. So a higher PE ratio signifies a higher return on investment. Of course, as with any of the other ratios, the price earnings ratio is most useful when you're comparing companies to each other. The last ratio we're going to look at is the rate of return on common stockholders' equity. And it's often shortened to the name just return on equity. And what it shows is the relationship between net income to common stockholders and their average common equity invested in the company. So again, we're going to look at the rate of return on common stockholders' equity for Kohl's Corporation for fiscal year 2018. Anytime that you are calculating a ratio just for common stockholders and it involves net income, you would have to subtract any preferred dividends. Kohl's did not have any preferred dividends. So Kohl's net income, 801 million, would be divided by their average common stockholders' equity. And you can see those amounts listed on the slide. After we make that calculation, we see that Kohl's has a rate of return of 15%. So normally a rate of 15 to 20% is considered good in most industries. At 15%, Kohl's has a return on equity that is considered good, but again, you would want to compare that rate of return with other companies that are in the same industry. And that is the conclusion of the demonstration for Learning Objective 7.